brilliant investment instrument and key force behind the near collapse of the global economy. Mortgage-backed securities are asset-backed debt obligations that entitle the holder to receive a portion of the cash flow generated by a pool of mortgages. And to understand exactly what they are and their role in the economy, it is useful to understand why they were created. Before mortgage-backed securities, banks provided mortgages to individuals as long as their liquid money allowed. Then Louis Ranieri came up with a brilliant idea. Pool together many mortgages and sell them as debt obligations to investors, similar to bonds. This way people can invest in mortgages without having to issue the loans themselves, while banks gain more liquidity to issue more loans. The process of creating a mortgage-backed security goes like this. A financial institution like a bank issues mortgages to homebuyers. These mortgages are secured by the properties being bought, meaning the property can be sold to recover losses if the homebuyer defaults, making them safer than regular loans. The loans are then pooled together and sold to a fund or institution like Fannie, Freddie or some private company. These institutions structure the loans into mortgage-backed securities, often providing guarantees to reduce investor risk. The mortgage-backed securities are then sold to investors, such as funds or individual investors. And in return, the investors receive periodic payments either monthly, quarterly, or semi-annually from people paying their mortgages. This process essentially makes banks middlemen between the homebuyers and the lenders. But what happens if banks abuse the fact that they can sell these mortgages to investors with no risk to themselves? They would have little incentive to ensure the mortgages they issue are high quality. This was a key factor in the financial crisis of 2008. In the lead-up to the 2008 financial crisis, the Federal Reserve had lowered interest rates to under 1% in 2003. This policy aimed to stimulate the economy after the burst of the dot-com bubble and the 9/11 attacks. The low interest rate made borrowing cheaper, encouraging homebuyers to seek out mortgages. At the same time, banks viewed mortgages as low risk because they could quickly sell them as mortgage-backed securities to investors. And investors saw mortgage-backed securities as safe investments since they are secured by the underlying assets. Also, who doesn't pay their mortgage? Well, since banks viewed mortgages as practically risk-free, they would issue them to anyone who asked, including people with no income and no assets. Because of rising defaults on mortgages, the housing market crashed, leaving investors with massive losses as the underlying properties were no longer worth the principal of the mortgage-backed securities. This caused a global economic collapse. Following the 2008 financial crisis, mortgage-backed securities underwent many regulatory changes and are now considered to be safer than they were prior to 2008. And they are very much still part of the economy today. As of today, more than 3/5 of the outstanding mortgage value is secured into mortgage-backed securities. There are many reasons to invest in mortgage-backed securities. They often offer higher yields than government bonds, and they give investors exposure to the housing market. They are also usually less risky than stocks, since they are backed by an underlying asset and sometimes guaranteed by the government. The risks associated with investing in mortgage-backed securities comes from the health of the real estate market. If the underlying mortgages fail, you could see substantial losses. Additionally, large changes in the interest rate pose a risk. When interest rates rise, the mortgage-backed securities become less attractive as higher-yielding investments become available. And in the case that interest rates fall, homeowners might refinance their loans or prepay them early, leaving investors with liquid cash at a time where only low-yield investments are available. Thanks for watching this video until the end. If you are interested in the financial market, watch this video about bonds, and hit subscribe for future videos.